Hello, everybody. Hope everybody is having a really, really great day. I'm Emily Price, and I'm with the Price Group at Keller Williams. And tonight, for those of you joining us for our live webinar, our topic tonight kicks off a series that we're going to host here at the Price Group that is all about building wealth through real estate investments. And so tonight, what we're focusing on is how to buy your first or maybe your next investment property. And again, this is going to be, we're so excited for our Louisville market, our Elizabethtown market, our Orlando market, Southern Indiana, Bowling Green, all of the places that we serve here at the Price Group. We're very excited to bring this information to everyone. Again, tonight is the first webinar of a series of what will probably end up being about 4 or 5 that is going to take you all the way through the process of how to buy, whether, again, it's your first investment property or your next one. You already have an investment portfolio and you're building that. Now, for those of you that have studied or learned about real estate investing in the past, as you might already know, there's lots of different strategies out there. So in this webinar series hosted by the Price Group, we're going to focus on a strategy called Hold. And this is based off of the teachings of the book Hold, which was written by Steve Chater, Janice Doty, Jim McKissick, Linda McKissick, Jay Papasan, and Gary Keller. So our strategies are coming from those teachings. So with that being said, let's dive right in. We're going to get started. And so as we move through this information tonight, I think it's a good thing to preface the fact that the hold strategy of real estate is not a get-rich-quick strategy at all. However, it's a clear process for how to invest in real estate over time. I love this quote that President Franklin Roosevelt stated years ago. He said, "Real estate cannot be lost or stolen, nor can it be carried away. Purchased with common sense, paid for in full, and managed with reasonable care, it is about the safest investment in the world." And so, here at the Price Group, our company is here to help our entire Price Group client family buy, sell, build, and invest. And so while we are always honored to help our clients buy and sell their personal, single family residences, where, your homes, where you live and raise your family and so forth, we also really want to make sure that we're serving our entire Price Group client family by empowering you with professional knowledge and wisdom about how you can also grow your wealth through real estate investments. And here at the Price Group, we believe in proven strategies, following proven models so you get a predictable outcome. And that's exactly what the Hold strategy teaches us. It talks about a very clear-cut strategy so that anyone, no limiting beliefs out there, if you're like, oh, I could never buy an investment property. Yes, you most definitely can. And you can purchase multiple investment properties. It depends upon what your goals are, but this is accessible for anyone. Anyone can achieve this type of investment as long as you have a clear plan that is based upon a model that's proven to work. And so that's what we're going to dive into tonight. Again, this is the first out of a series of webinars that we're going to bring to our Price Group client family. And tonight, you're going to find that we're going to focus primarily on the very objective number crunching data of how to really understand in math, so to speak, like crunching those numbers of why investing in real estate is a really, really smart thing to do, and kind of what numbers you want to look for in order to know that it is a good investment. It's much more than like, oh, this is a deal, or this is a really hot area, or I just have a gut feeling about this. So again, here at the Price Group, we're honored to be your number one real estate resource. And as our Price Group client family knows, We are not your traditional real estate agent. We serve primarily as a real estate consultant, so that as your trusted professional, we can really equip you with the best knowledge and empower you with understanding how you can use that knowledge to serve you and your family's goals going forward. So with that being said, here we go. All right. So again, here at the Price Group and here at Keller Williams, we're really big on models. A model gives, clarity is power, and a model often gives a step-by-step action plan so that you know where you're going, you understand the journey, and then you have clarity as to how to repeat it. So your success starts to amplify, right? And so again, when you're thinking about purchasing your first investment property or growing an investment portfolio you've already started, when you have a model that you can follow, it basically serves as your business plan. And when you're thinking about being the owner of investment properties, that investment property is a business for you. It is making you money without you directly exchanging your time. So it's a great way to leverage your money, again, throughout the process of holding the property so that you can build your wealth now and into the future. So when we're talking about following a model, the model that we're going to focus on in the hold strategy, it's a 5-step model. The first part of the process is that well, let's back up. It's find, analyze, buy, manage, and grow. All right. So we're going to take what might for some of us feel like a really complicated, again, I talk to so many people that are like, I could never do that. I'm not set up to do that. That's not true. So take all those limiting beliefs and put them on the shelf. And so sometimes when you look at something that feels unattainable or complex, when you just chunk it down, it gets you going and you put one foot in front of the other, and then all of a sudden you're achieving the goal that you set out to do. So as we chunk down the process of how would we go about with our first investment property, it is those 5 steps. You're going to find the right property for the right terms and the right price. We'll talk about this later, but this is where throughout this whole process, your trusted real estate professional is so important, but especially in helping you find the right property from the very beginning. Once you find it, that doesn't mean you purchase it. We don't go find to buy. There's a very important second step. And that second step is analyze. Okay. So again, here at the Price Group, the way we help our clients, whether it's through buying your own personal residence or whether it's through buying an investment property, we want to help you analyze the total opportunity that you have in front of you before you move forward with actually purchasing it. So in analyzing a property, that's when we're crunching the numbers, looking at the terms, and making sure that it makes sense. So right now you're probably thinking, well, how do I know if it makes sense? Well, that's what we're going to talk about tonight. So sit tight. So after you find that property, we crunch the numbers and we hold those numbers accountable to the model that we're following to help set you up for success going forward. Then it's time to buy. Now, a big part of the hold strategy in the buying part of the process is that you want to buy an investment property where you can make money going in. So what we mean by that, and again, there's lots of different strategies out there, not saying any are right or wrong. It's just tonight we're talking about the hold strategy. And in this strategy, what it looks at for great proven results is that when you make the purchase, you're making a purchase, again, where you're going to be able, you've got your numbers set correctly. That comes in the analyze step. That is step 2. And you're making a purchase so that you are making a positive cash flow on day 1. We're going to talk a little bit more in a moment about what that means. What that doesn't mean, is what we see some folks do, is sometimes people tend to lean into an investment purchase based upon kind of speculation. They're speculating that the market's getting ready to turn, or they're, in their favor, or they're speculating that it's going to be the next hot new community and they're getting ahead of it. Again, not saying that any of those thought processes are ever wrong. It's just that with the hold strategy, Hold strategy is a little more conservative with the way that you think about investing your money. And with that being said, we're going to focus on buying investments where the numbers set up from the beginning have you set to make money going in. All right. Step 4 is manage. So once you've secured that investment property, you got to manage those tenants and properties like a pro. That's where more leverage comes in. That doesn't mean you have to do it. Oftentimes a smart investor, part of that team is that you have a really strong, trusted property manager. Because again, the beautiful thing about investing in real estate is it can make you money in a leveraged way, which means you're not exchanging your minutes or your hours for dollars. You're letting your money work for you while you go forth and live your life. And that money is working for you without you directly dumping all of your time into that effort. And so when you manage the property, if you like that idea of leverage, that's where a property manager comes into play. So it doesn't have to be you. You don't have to, because you want to be a real estate investor does not mean you also have to be a property manager. So keep that in mind. And then step 5 is grow. And so that is when you can use this strategy. Again, that's the power of when you have a clear-cut model with clarity and a step-by-step process and you follow it, that's when you can repeat it to continue to grow your wealth and your financial freedom. So doesn't that sound awesome? Sounds awesome to me. So let's keep going. For those of you that are just joining us here in our Price Group Live webinar, we're talking about how to buy your first or your next investment property. And this, again, is a series of several webinars that we are so excited to launch and deliver to our Price Group client family and friends so that we can empower you with all the best knowledge you can have in terms of investing your money into real estate for future wealth, growth of your wealth. So what we're going to focus on tonight is now we're going to dig deep into understanding from the very beginning, what is it objectively as a smart investor that I want to know or think about before, at the very, very beginning? How do I need to understand how this could be an opportunity for me and how this could work for me? So again, the point of investing is to grow your wealth, right? To do something with today's dollar that in the future you're getting a return, a nice positive return on that money. You're making more money, right? Layman's terms, that's what it's all about. So a smart investor understands that there's 3 financial returns that we're going to focus on, especially when we're talking about the hold strategy. So a financial return is basically, how do I turn today's dollar into more dollars into the future? How do I get a return on that investment? And so with the hold strategy, there's 3 ways to measure that: cash flow, debt pay down, and appreciation. And if you're looking at this right now and you're like, Emily, I have no idea what you're talking about. This is not how my brain is wired. This isn't for me. Just hang tight with me. I'm going to break it all down. I promise you it's going to make sense. All right. So let's go deeper with that thought. So as we explore those 3 different ways that you're going to measure your financial return as you're thinking about being a smart real estate investor, what we're going to do as I kind of teach you what those 3 different financial returns are, we're going to kind of use a hypothetical scenario, right? And this is the scenario that we're going to use to demonstrate how those financial returns play out. So the example that we're going to use is let's say that you're going to make a real estate investment purchase. And the list price, which means the advertised price, the house is for sale. It's showing up on choosethepricegroup.com for a list price of $170,000. Okay. Now, we're going to also say in this scenario that in the negotiations to purchase, you're able to work with your real estate professional and you're able to smartly negotiate in your favor. And let's say, and for this example, you're able to negotiate 10% off the list price. So in this case, That would be a reduction of $17,000. So you would actually land on a purchase price of $153,000. Now, I'm going to pause right here because I can hear all the little questions in everybody's brain or all the feedback. And that is, here we are at the moment, we're in July of 2021, and it's a real zesty market. However, there are still really great opportunities out there. It's just, especially in this market, as an investor, you've got to make certain you're working with a real estate professional to help you find those opportunities. In this market and all kinds of markets going forward, sometimes the greatest opportunities are on the open public markets, such as what we call the MLS, the multiple listing service. That's what you see when you go to the different websites on your phone and so forth. And a lot of times, the very best investment opportunities are not on the open public market at all. And so oftentimes the best way to know about those opportunities is to be aligned with a real estate professional who is, kind of hunting for those opportunities that haven't even made it to the market yet on your behalf. So keep in mind that what you see on your public MLS is always only a part of the opportunities that are out there for you, and the way that you get access to all the opportunities of all the properties, again, whether it's for your single family residence purchase or it's for your investment portfolio, the best way to ensure that you're getting to see everything is to make sure that you align with a professional real estate agent who is skilled in being able to find you off-market opportunities. Price Group can do just that and does do just that. So if you're needing that service, we'd be happy to help you. So you negotiate to a purchase price of $153,000. From there, in this scenario, let's say you make a down payment of 25%. Now, little asterisk, little note here. You don't necessarily have to always make a down payment of 25% when you purchase an investment property. So if you're thinking, gosh, that's a lot of cash, don't let that stop. Don't let that close your mind to building wealth for yourself through this venue. Keep in mind that as you talk with trusted financial, whether it's loan officers, mortgage brokers, things like that, all of those different companies have different programs. And so there could be lots of different opportunities out there for you in terms of managing your investment purchase in conjunction with your access to the cash flow that you have for that investment. Okay. So in this scenario, we're saying that you're making a 25% down payment. So $38,250 is the cash that you're going to use to purchase this property. And then the remainder of that, the other 75% of that purchase price, in this scenario, you're going to take out a 30-year mortgage. And so that would be on the amount of $114,750. All right. So that is the number scenario that we're going to use as we continue to kind of talk through this topic. So as we move forward, so again, we've got 3 different financial returns that's going to be the main focus of tonight's conversation. The first financial return is called cash flow. And so what I'm going to do is I'm going to kind of explain what all of this means kind of in, again, layman's terms. All right. Because again, sometimes I don't know about you, but sometimes all this lingo can sound like a foreign language. And so we're going to kind of chunk all that down, take out all the complexity, and we're just going to kind of straight talk about what all of this is, because it's simpler than sometimes our brains want to tell us it is. So we're going to talk through what it means, and then I'm going to show you how you would apply it in analyzing a hypothetical or an actual purchase that you're considering. So cash flow, when somebody's talking about cash flow, what they're referring to is they're referring to the total amount of money that remains after all expenses are paid. All right. So when you have the hold strategy is based upon the fact that you're going to hold property over a period of time. This is not a flip strategy. And then that means that you're going to have a tenant that is leasing that property from you. So what do tenants do? They pay you a monthly rent. And so that monthly rent is the income, the dollars that come in. Okay. So that monthly rent comes in, and out of that payment that you would receive each month, you have to pay all of your expenses, taxes, if you have operating costs, which, can include paying a property manager, things like that. And then of course, your mortgage payments and things that are involved with that, insurance. If you have HOA fees on the property, you're going to pay all the things. So after you pay all the things, cash flow is what you have remaining. Okay. It's what you have left over. So it is a direct form of financial return. It's direct and immediate and liquid because you receive it each month, right? Your tenant pays you the lease every month, you pay your expenses every month, and the balance is the positive cash flow you have left over. And that's liquid cash dollars that you have each month. Having positive cash flow is absolutely crucial in the hold strategy because remember, at the beginning of tonight's webinar, I was speaking to the fact that part of this strategy is that you want to make sure you're making choices that set you up to make money going in. Okay. So the absolute bare minimum is that when you're crunching these numbers and you're working all your numbers and you're looking at what your monthly expenses would be to carry that investment property, and you're studying what the projected likely rent would be on that property, you want to make sure your cash flow is at minimum $1. Okay. Now, for the sake of this model and this conversation, truly the goal and the standard that we recommend you set for yourself is that you positive cash flow at least $100 each month. Okay. So again, the power of understanding all of this is that when you understand how the numbers work and you understand the targets that are important to hit, and you're working with a real estate professional that also understands that, then you're able to, again, remember when we talked about that analyze step earlier, you find, analyze, buy. In that analyze step, you're able to crunch all of the numbers to see if the math works out. You got to make sure that the math hits the target that the model is telling you to hit. So in this situation, we want to make sure that when we crunch the numbers before we decide to buy it, that we're positive cash flowing $100 or more. That's the target. All right. Now, the great thing about that $100 or more is that can serve as capital for your future real estate investments. So that is one way. Remember, step 5 of the model is grow. So one way that you can compound and purchase more and more investment properties to build your wealth exponentially is that you reinvest your capital into this business that you have of your investment portfolio. Okay, so that's what cash flow means. After I pay the bills, what do I have left over? So let's look at how that plays out with real numbers in this scenario. So again, how to measure the financial return of the cash flow. Okay, so using the previous example, let's say that you're going to charge a monthly rent that hits that target, $100 cash flow positive. And remember, that's the amount of money you receive from the tenant, that's the rent, less all the expenses that you have with the property, taxes, mortgage, etc. And so then the balance of that is $100. So what we're going to look at to measure the financial return of cash flow is we're going to look at what that cash flow is for 1 year. Now, remember, hold is a long-term play. You're going to hold this property for more than a year, but we're going to measure it right now based upon 1 year. So $100 times 12, because there's 12 months in a year, that's an annual cash flow of $1,200. Okay. Now, when we're talking about rate of return and investment, you often hear people talking about percentages. What's the percentage rate of return? And in a minute, you're going to learn that hold suggests a certain, again, we have a target of $100 or more as positive cash flow. We're going to also learn a target of, well, what should my total rate of return be to know that it's a good real estate investment when I'm in that analyze part of the process with my trusted real estate professional. So we're going to talk about that in a second, but that is why we're zeroing in on percentages right now. So how do you measure this in terms of a percentage of financial return based upon cash flow? Well, what you're going to do is you're going to think about, well, how much cash dollars, how many cash dollars did I put in to this endeavor from the very beginning? Yes, the property, you bought it for $153, but the only cash you put into it to do so was that 25% down payment, which is $38,250. We talked about that earlier in this scenario. Okay, so then the way you're going to do kind of like the math equation is that you take that positive annual cash flow and you divide it by the cash dollars that you invested. So for this scenario, what's my positive annual cash flow? It's $1,200 because I got $100 every month. There's 12 months in a year. $1,200 is what came back to me in positive cash flow for 1 year. And I divide that by 38,250 because that's how many dollars I had to pay to get that mortgage to buy the property. And so that comes to a percentage rate of 3.1%. So in summary, in year one, you have a 3.1% rate of return on cash flow. Remember, there are 3 ways to get a financial return on an investment property, and that's just one of them. Okay, so that's one way. So in 1 year, we already have a 3.1% return. Awesome. Let's look at the second way because all 3 ways work simultaneously. It's like 3 trains running down the track at the same time. That's why real estate investing is so fun and so awesome and so smart. Okay, so the second way that you make a financial return. The second way that you're going to generate a financial return on your investment is measured by what we call debt pay down. Okay, layman's terms again. What's the debt when we're talking about this scenario? The debt is the mortgage, right? It's the money that you borrowed so that you could purchase the property. So debt pay down is when you pay down the debt on your investment. So you pay down the mortgage balance, right? Because every month when you have a mortgage, you have to make a monthly payment. And in that monthly payment, there's lots of things, usually principal, taxes, interest, sometimes some other stuff. That's dependent upon how you set up your loan product with your loan officer or your mortgage broker. But out of that monthly payment, the portion of it that's going towards your principal, which in this case was about $114,000, because we made a 25% down payment, and then we borrowed the remaining 75% to purchase the property. So every month when a mortgage payment is made, the part of the mortgage payment that goes towards the principal is the part that pays down the debt. Okay, so you have so many wins here. One win is that each piece of debt pay down increases your equity. Okay, equity is the equity in a property is how much wealth that you have in that property, right? So every time you pay down your debt, your equity goes up, and the equity is the wealth that you're generating in this, or part of it. All right. Another win is that your measured rate of return is going to increase as you pay down more debt. That'll be something that we dive into a little bit more in future in the next couple webinars in this whole series that we're rolling out for you guys. But just know, kind of for right now, that rate of return only goes up. You only make more money year after year with an investment property as you pay down the debt. So that's positive as well. And then perhaps one of the biggest wins of all is that you're not even paying it. Your tenants are. Somebody else is paying down your debt, and you are reaping the reward of that. That's a lot of leverage. So from there, let's talk about how we would measure that, right? Because again, we're talking about how we're smart investors. We're not going on a gut feeling because, I just feel like this is a good deal. This is such a hot, great area. I just love this little house. We're not doing any of that. That's where people can kind of get in trouble or get unexpected results, or the results they weren't looking for from real estate investing. We're going in the Price Group style, the Keller Williams styles, that we're going in with knowledge, objective data, following a proven model. And that helps to keep your investment safe. So we got to know how to measure the financial return of our debt pay down. So using the previous example, let's say that the annual amount of principal paid down in 1 year is $1,179. And I know you're like, that doesn't make any sense, Emily. Remember, your monthly mortgage payment covers lots of things. Again, principal, interest, taxes, insurance, blah, 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 lots of stuff. So you're only paying, the principal is only a part of it. And when you go to close on a property and you are getting a mortgage, one of the documents you get out of closing is an amortization schedule. And so if you're getting a 30-year mortgage, which we are in this scenario, when you go to close, your lender has provided you, it's like a massive spreadsheet, and it shows you every payment over those 30 years, and it shows how much interest and how much of that payment goes to interest with each payment, and how much goes to principal each payment. And the thing about amortization is that it's not equally chunked out for 30 years. It's on kind of, they have that amortization schedule set up a little bit kind of like on a sliding scale. So synopsis of that story is that in the very beginning years of a new mortgage, you're going to pay, while your monthly payment might be fixed, more of it is going to go towards interest, and less, like a bigger piece of the pie is going to go towards interest, and a smaller piece of the pie is going to go towards principal. All right. So truly, if you've never looked at an amortization schedule, it's kind of fascinating to see how much of it goes to principal, especially in year one. Now, the beautiful thing about amortization is the longer you own the property, the more goes towards principal, and that's in your favor, so forth and so on. So in this scenario, though, we're going to be real realistic and real conservative, and we're going to say that over the course of 12 months, you paid that mortgage down $1,179. Okay. Now, you're probably thinking, gosh, that doesn't amount to anything. Well, hold on. Let's see. So how are we going to measure what the rate of return of that is? Because remember, paying it down is increasing our equity. All right. So that is how paying down the debt makes a financial return boomerang back to you. And so here's how we're going to measure it. Your cash dollar investment, remember, how much cash did you have to put out, give to get this property? That is your down payment for your mortgage. And again, in this scenario, if you were with me for the beginning of this webinar, we went through we're using one scenario to kind of teach all these strategies with, and that was $38,250. That's how much you paid with your own cash to get this property. Now, so if you paid the $38,250 and 1 year has passed, and now you have an annual debt pay down for the first year of $1,179, the mathematical formula of how you calculate debt pay down is you take that debt pay down amount, $1,179, and you divide it by the amount of dollars you invested. Again, not the purchase price, the cash dollars you took out of your bank account and you spent. That's what we're talking about. So it's the relationship between 1,179 and 38,250. And that math works out to be another 3.1%. So this is where it just gets so super fun. So in summary, we're through 2 of the 3 ways that you want to look at financial returns on your property. And just with these 2 so far, in just 1 year, you have a 3.1% rate of return on your debt pay down. And remember what we talked about previously, you also have a 3.1% rate of return on your cash flow. So 3.1 plus 3.1, we're now sitting at a total rate of return of 6.2%. It's not too shabby, and it gets better. So now let's look at the third point. The third way of how to measure financial return is through appreciation. Okay, so let's put some caveats here because, again, we want to be realistic and conservative and smart. All right. Appreciation does vary year to year and location to location. Most definitely it does. Most definitely. So when you're looking, and we all know that our housing market goes through cycles. It's, it kind of looks like this. And so seller market, stable market, buyer market, stable market, seller market, and it goes through that cycle. And when you study the housing cycle in our country, it tends to go through that whole one cycle, about every 10-ish to 12-ish years. All right. So understanding that, then it becomes very smart to say, well, if I'm going to measure appreciation, I got to make sure I'm doing a smart average, right? Because you don't want to just zero in on like, well, what was the appreciation of just the last 2 years? That's not a smart way to do it because our market is always going through that cycle, right? So by looking at an average from a big chunk of time, it helps to truly get a smart average, no matter if it's a seller market, stable market, buyer market, stable market, right? So here's the number we're going to use. We're going to use the annual appreciation return of 4.4%. Where do we come up with 4.4%? Well, with the hold strategy, it's in accordance to the U.S. Census Bureau and the National Association of Realtors. And 4.4 is the median number of appreciation in our country from 1970 to 2010. That's a 40-year span, and that includes 3 housing downturns. Okay, so we're looking at a large piece of a large timeline to get this number. So an appreciation represents growth in value over time. The beautiful thing about real estate is that if you hold it long enough, you almost always have positive appreciation. Whereas when you buy other things, you have depreciation, and real estate appreciates. That's why it's just such a really, really smart investment. Okay, so if we're saying, okay, well, what does that mean? Let's talk about how we put that into our scenario with real numbers. Like, what does that even mean? So using the previous example, let's say that the property at the time of the purchase was valued at $170,000. So, okay, stay with me. Let's rewind. We talked about this hypothetical scenario, and that scenario was list price was $170,000. You work with a fantastic real estate professional, such as the Price Group, negotiates a strong opportunity for you, gets 10% off the purchase price, and you're purchasing for $153,000. Now, when you talk about appreciation, it's not based on what you bought it for. It's based upon what the property was worth when you bought it, because that is the asset that you have gained, right? So the property in this scenario, we are saying that the property was worth $170,000. And so so now how we're going to measure it. So the initial value of the purchase was $170,000. The annual appreciation, the average, like we just talked through in that 40-year time span, is 4.4% across the nation. So the mathematical formula is that you're going to take the initial value of that purchase, and you're going to multiply it by the annual appreciation average rate, which is 4.4. So 170 times 4.4 is $7,480. Okay. So again, that formula. So then now when we want to get it into percentage form so we can measure the rate of return. The formula is going to be appreciation divided by the cash invested. Okay. So again, let's back up. Clarity is power. How do we find what the appreciation actually it is likely for 1 year? We take the initial value and we multiply that by 4.4, because that's the number that we got from the data that we talked about a moment ago across the national average. And that comes to $7,480. So we're saying based upon the historical national data average in 1 year, on average, that property that started at a value of 170 would, in theory, after 12 months, now likely be worth 177,480. All right. So 7,480 is how much it has appreciated, how much it has grown in value. And we're going to take that appreciation amount and we're going to divide it by, again, the amount of cash dollars we invested to begin this journey in the process, which was our 25% down payment to our mortgage. And that was $38,250. So 7,480 divided by 38,250 is 19.5. So you have a rate of return from your appreciation of 19.5%. So let's tie all this together with a beautiful bow. So in summary, in year one of purchasing your home your investment property that was valued at 170 and purchasing it for 153 and making a 25% down payment, okay? And then making sure that the rent that you're charging positive cash flows by just $100 each month. In year one, you're going to have a 19.5% rate of return on your appreciation. You add that to the 3.1% rate of return on cash flow that we previously calculated in tonight's discussion, and you add that to the 3.1% rate of return on the debt pay down that we also talked about a moment ago. And now you're at a total rate of return for 1 year of 25.7%. Okay, so here's how you got to think about that. There are so many different opportunities in our world to invest your money. And so, whether it's in a savings account or stocks or what have you, there's lots and lots and lots of different ways. And whenever you're investing your money, investors are always wondering, well, what's my rate of return going to be, right? If I put this money in, how much money am I going to get out over a certain amount of time? So when you are comparing and contrasting different ways to invest your dollars, you really want to pay attention to the rate of return, because the higher rate of return, also coupled with the risk factor and so forth, that is the indicator that tells you how you're going to literally, as the phrase goes, get the most bang for your buck. So in this scenario, you're going to have it's projected that you would have a total rate of return of 25.7%, which beats almost every investment opportunity that most of us have access to. So that's good news, you guys. That is really good news. So let's keep going. Okay, so you're like, okay, that's awesome, Emily, super. We talked about 1 year. But how do we see past 1 year? And, you said this is a long-term strategy. So then how do we kind of keep figuring it out year over year over year over year? Well, there's this really easy, simple rule called the rule of 72. And so the rule of 72, it's a very, very tight estimate. It is an estimate, but it's very, very tight in how all the numbers work out. So the rule of 72 helps you to project your final return into the future. So let's talk about what we mean with all those words. So ask yourself this question, how many years would it take me to double my money, right? How many years would it take me to double my money? So a good target, remember earlier this evening, I said, just, when you're following a proven model and a proven strategy, and remember the overall chunk down process of moving through this being a real estate investor is that you first find the property, you second analyze it, you third buy it. Buying it is not first or second. Then you manage it and then you grow it, right? So in the find and the analyzing part, you've got to know what targets you are trying to hit. So we've already talked about one target that you're wanting to hit is a positive cash flow amount for this strategy being $100 or more. Another target that you're going to want to hit is that you want your total rate of return annually to be between 17 and 20%. Again, the situation we just worked through was even north of that, which is awesome. But 17 to 20% is what what the hold strategy recommends that you target in your analyze part of the process. So if you are in the analyze part of the process and this opportunity does not check out against your targets, your positive cash flow target and your total rate of return target, you don't buy it. It's that simple. It's super black and white, which again makes what some of us think would be a really complex kind of like, I could never do that at arm's length kind of idea about being a real estate investor. As we strip away the complexity and get to the simplicity, it makes it much more attainable, right? And why would you not deserve to benefit from this, to leverage your money in this way to build wealth for you and your family, for whatever it is that you are needing or wanting to do, right? You deserve to be able to have access to this. So the first way to have access is to have the knowledge. And again, here at Price Group, we are very, very passionate about empowering our client family with the knowledge and the counsel and the guidance of how we can help you use real estate to benefit you. All right. So all that being said, let's go back to this rule of 72, because it's like, great, Emily, you've talked me through what happens in a year, but how do I think about what happens past that? So if you're asking yourself the question, how many years to double my money? So to calculate with the rule of 72, you're going to follow this formula. You're going to take your total annual rate of return expressed as a whole number, not as a percentage. And you're going to divide it by 72. because it's the rule of 72. I don't know how this works out. I was just taught this and it actually works. It's like math magic. So there you go. All right. So again, we are kind of stepping away from our earlier example. And so right now we're just talking about if our general target as a real estate investor is 17 to 20% total rate of return, let's say that we're working on a 20% rate of return. So the mathematical formula is 20 divided by 72, because it's the rule of 72. It's no more complex than that, is 3.8 years. So when you are able to identify with your trusted real estate professional a property that is going to produce for you a 20% rate of return on the money you invest, on the cash dollars you invest into it, you're going to double your money every 4 years, right? Even though you have a 30-year mortgage, you're going to double the money you put into it every 4 years. That is really, really powerful. All right, so let's go on here. So, all right. So the main topic of tonight, and again, tonight is our first series in a how do I buy my first investment property or my next investment property complete webinar series that the Price Group is bringing to all of our markets that we serve in Louisville and Southern Indiana and Bowling Green, Elizabethtown, Orlando, Florida. What we've really, really focused on tonight is to start, you got to start smart, right? You've got to start smart. You've got to be aligned with a real estate professional who can help guide you through a proven model and proven strategies to help safeguard and protect your investment, to protect your hard-earned dollars that you are investing for yourself. So we've talked through what that looks like, how and what the opportunity is. So as we've talked about 3 different ways to get a return on your money, and those ways are positive cash flow, debt pay down, and appreciation. And again, it's like running 3 trains down the track at one time. It's amazing. You benefit from all 3 at the same time. Now that you understand how that works, that helps you to then understand, gosh, real estate investing is a super smart way to invest my cash dollars. And now we've got the knowledge that's going to help us in that analyze phase. Because remember, we also now have the knowledge of what does the overall process or the model look like? And being a real estate investor is really just a 5-step model. It's buy. That's incorrect. It's find, analyze, buy, manage, grow. All right. So with that knowledge that we have as of tonight, the question is, well, what do I do next? All right. So what you want to do next is you want to establish your wealth building goals for the future. All right. And what I mean by that is you want to begin with the end in mind. What are you working to get? If you decide that you want to be a real estate investor or that you want to continue your real estate investment journey, if you've already started, what is it that you're intending to get to? That usually looks like a dollar amount, okay, in a certain amount of time. All right, so that you want to begin with the end in mind. A lot of people will use real estate investing in terms of a big part of their retirement strategy, or perhaps a big part of how they are going to set themselves up to help fund their child's college education. But begin with, where is it that you're wanting to go and in how much time? And as you identify that, it's going to help you make again, think about it kind of like as a business plan. It's going to help you make your total business plan of what your total amount of investments and kind of your process for how you want to move from 1 and then maybe to 2 and then maybe to 3 and then beyond is going to look like. That's a whole deep dive conversation that we here at the Price Group can help you with in a consultation one-on-one, because everybody has different goals, right? You're also going to need to make a plan. If you already have cash to invest and you're just in the process of figuring out what the smartest way to invest it is, that's awesome. If you don't already have cash to invest, that's okay too. Everyone's got to start somewhere, and the only thing you got to make sure you do is just get started. All right. So perhaps your getting started is to make a plan for how you're going to save for a down payment and a reserve fund. All right. So how are you? And remember, small efforts compound, and over time, you have big results. So you can start saving today in a very, very small way. And as long as you're consistent with your savings over time, you're going to get to where you want to be. So you're going to want to make a plan to save for a down payment and reserve fund if you don't already have liquid cash available to you. And then you're going to want to go, you can never start too early in building a team of professionals around you, right? No one succeeds alone. And the stronger the team that you have around you, the more leverage you have. And that makes this whole process that much easier and that much more effective for you. So what does your team of professionals look like? Let's take a look at that. So your team of professionals, and again, it's never too early to start seeking out positive, powerful professional relationships so that you've got a team to help you on your desired journey. It's a real estate agent, it's a lender, it's a property manager, it's an attorney, and it's a CPA or a certified public accountant. All right. Now, here at the Price Group, we would love the opportunity to earn the opportunity of being your trusted real estate professional through your efforts, helping you build out that real estate investment portfolio that gets you to that end in mind that you're thinking about. And if this is something that you'd like to talk with us more about one-on-one, I believe the numbers for all of our markets are running on the bottom of the screen. Feel free to reach out to us. We will get you set up with a complimentary, no strings attached consultation where you can meet with myself or any member of the Price Group. And we will work to build out a plan that serves you. And if you're like, I don't even know how to make that plan, like I don't even know how to do all that. Well, wonderful. That's why you would want to talk to us, because one of the things we're really great at is we're really, really great at putting your puzzle pieces together. We're really, that is our strength. You just let us know what you want to do, and then we'll help. We want to understand what's important to you, and then you can leverage us in helping us and we'll help you put the plan together in a way, put your puzzle pieces together in a way that serves you and gets you to where you want to be. So the way we operate at the Price Group is, it is literally all about you. We're just here to serve as your trusted real estate resource so that we can help you achieve whatever goals that you have that have to do with real estate. So we'd love the opportunity to be able to help you in that way. If you don't already have a trusted lender, we have great lenders that offer all different products that we can connect you with. So you can find the investment lending product that works best for you. You'll want to find a really great property manager, and we can also help you find that person unless you're looking to become a property manager yourself. But remember, if you build a team around you, you have more leverage, and you just let that money work for you while you're doing other things, right? You want to find a trusted real estate attorney. And again, Price Group can help connect you with trusted real estate attorneys in your market. We already have those in our network because we want to be able to kind of be your one-stop shop for you. So we can just connect you with all the relationships that we know will serve you. And then it is very smart to have a CPA, a certified public accountant, that knows real estate. There are lots of tax benefits and all. That's a whole nother conversation, but lots of different things that work for you as a real estate investor. And so you want to make sure that you're aligned with a great CPA who's going to leave no stone unturned in terms of amplifying your benefits of being a real estate investor in that way as well. All right. And we're almost done with our first webinar of the series. So we're going to kind of wrap this up, and I'm going to let you know what's coming next. So again, we're building out an investment webinar series for you so that we can equip you, empower you with all this information. And then we would love to serve you as your trusted real estate resource along this journey. If you would like a link to this webinar so that you can watch it, go back and watch it again, or perhaps share it with your spouse or a friend or a family member, just shoot us an email at info at kwpricegroup.com, and we will send you a link to the recording so that you have access to it again into the future. In our next step, in our next segment in our Price Group Investment webinar series, we're going to do a deep dive into the first step of that overall model. Because remember, the model is find, analyze, buy, manage, grow. So the next segment of the series is going to look at how you create your personal investment criteria. Okay. And that is going to have to do that's aligned with, again, beginning with the end in mind. Well, where is it that you're trying to get to and in how much time? And that's going to help you refine your personal investment criteria. We're also going to talk about how you create your property criteria. So you've got to know what your personal investment criteria is first, and then we've got to work together to understand what the property criteria is that's going to be in sync with that. All right. And then from there, we identify potential properties, right? And so that's in that find spot. So that's what we're going to deep dive into next. And then the following segments will be focused on analyze, buy, manage, and grow. So looks like we're going to end right on time tonight. And so in conclusion, as we are wrapping this up this evening, we here at the Price Group at Keller Williams, we want our services that we're able to provide to all of our markets is that we are your trusted real estate professional when you're selling your property, when you're buying property, when you are building property, and when you are investing in real estate. We can help you in all those components of real estate. And oftentimes how that starts is that we are not your average kind of traditional real estate agent. Here at the Price Group, we are a full service real estate organization that is serving each of our clients at the highest level. Our commitment to you is 5-star service. Every client, every time. Again, no matter if your goal is selling, buying, building, or investing, we have the 5-star pledge that we make to you no matter what. And from the very beginning of our business relationship together, we ask that you hold us accountable to delivering you that 5-star service pledge that we make. So 5-star service, every client, every time. And a good next step would be for you to do 2 things. One is make sure you don't miss out on our next segment in this wealth building investment series on the hold strategy. So while we will advertise when that is going to hit the internet live here soon in the future, we're going to advertise that on our social media pages, on our Facebook pages. So you can find us on Facebook at the Price Group Greater Louisville, the Price Group Orlando, the Price Group Southern Indiana, the Price Group Bowling Green, the Price Group Elizabethtown. So one smart thing for you to do right now is for you to like our business, to like those pages or the page that's specific to where you live, so that way through your social media feed, you won't miss a beat or miss anything that we announce there. So that I don't want you to miss out. I want you to have access to all the best information. The direct thing that you could do is just email us right now at info@kwpricegroup.com. Just quick little note saying, hey, I want to make sure that I know when the next part of this series is rolling out, and we'll get you on that list, and we'll make sure that we send you a personal invite so you've got the access to the next piece of this webinar series. At any time at all, you can find a wealth of information, whether it's about buying, selling, investing, building, or even beginning or growing your career in real estate through choosethepricegroup.com. So that's what your next steps would look like. And I appreciate so much everyone who's joined in with us this evening. I hope that this has at least dropped one little nugget of wisdom in your head that you didn't have before you logged on with us. And again, I'm Emily Price with the Price Group at Keller Williams, and we are so honored to serve the markets of Orlando, Florida, Louisville, Kentucky, Southern Indiana, Bowling Green, and Elizabethtown, Kentucky. So go ahead, reach out to us. Let us know how we can help you meet your real estate goals. And you can always find us 24/7 at choosethepricegroup.com. Thanks so much, everybody. And I really hope you enjoy your evening. Bye.